If you want to get yourself in a good position financially, you better have a tax strategy, because if you don't, it's going to take you a lot longer. Some of you guys are paying 30, 40% in taxes. That's 30 or 40% of your year, 30 or 40% of your entire working life. Think about that. What's 40% of 40 years? That's how many years you're going to work just to pay taxes? Come on, not me. Hey everyone, welcome back to the Freedom Factory. Great to have you guys back. Hey, listen, we are closing in on 52 episodes. This one today is like either 51. We're getting close. It's going to happen in the next couple of weeks, and that's pretty exciting. A whole year we've been together here on this podcast, and I'm excited that I've been able to be that consistent. Because honestly, when you start something out like this, and maybe you've experienced this, you start something, it's a great idea, you start, and then you realize the amount of work that is involved. And maybe sometimes we don't finish what we start, a lot of times. And I think after I crossed this year threshold, although it's still the work is there, obviously we've gotten a good rhythm. And I'm excited about the future of the podcast, because I believe we're only getting stronger with our audience. You guys are actually giving me feedback now, which is really great, about things that you're doing and success you're having, the success that you're having because of what you're hearing here on the Freedom Factory. And so I'm excited. Today is going to be a little bit different. I told you a few weeks back, maybe a month or so ago, that we were going to be purchasing a piece of real estate, an investment property. If you've listened to the show long enough, you know that for many years, my wife and I were real estate investors. It's where the majority of our income came from. And it was also part of our first retirement strategy. So this goes back, guys, to 1997 is when we bought our first investment property and started learning the power of residual income. And actually not learning about it. I saw it as a younger person with real estate, but actually myself, my name on the mortgage, my name on the deed, that sort of thing, 97. And of course, the 2008, 2009 financial crisis happened. That had a major impact on our real estate investment portfolio. And we shifted gears. Well, I've never lost interest in real estate. I still believe real estate is a fantastic investment. I believe that right now it's a little bit more difficult, but also I believe where there is difficulty, there is opportunity, always, always. And so that's what I want to be sharing with you guys today is not necessarily just the real estate deal, because some of you I know maybe aren't interested in real estate, but a lot of you are. And I'm going to tell you that, there are plus and minuses, right? There are pros and cons to this. But I want to walk you through the deal. I want to explain to you what I was thinking, and maybe something will click for you. Maybe it will inspire some of you. Some of you will definitely laugh at one of the mistakes I've made along the way already. You won't believe what happened here. But it's the mistake that I made. How can I say this? Will be proof of what I'm about to share with you works. Okay. So anyway, here we go. So I've been looking for a long time. And recently, last year, we shifted on how we were doing some of our tax strategy. And we had a defined benefit plan, self-directed defined benefit plan. That basically means that we could choose how the investments were done, that we put it into. I put it into it because of the fees. I put it into it because I wanted to use the money to multiply the money faster than it was actually growing. They were doing a good job with it. It was growing, but I just wanted to do something different. And we did that. We pulled the trigger on that last year. That took forever, forever. If anybody ever, before you get into a defined benefit plan, guys, ask a lot of questions. And I'm just here to tell you, it is a lot of work to get out, to close them out. It is paperwork upon more paperwork. Oh my goodness. It's just a lot. Okay. So, word to the wise there. If you're going to get into a defined benefit plan, be ready for a lot of work on the back end to close it out. And some surprises too when it comes to contributions that they make you do at the end. So, anyway, we closed that thing out, and that was providing us roughly a six figure, not roughly, an over six figure yearly tax shelter. We were able to put, 100,000 ish in there every year, and we were able to shelter that. So we weren't paying direct impact. That money was going into that account, and we didn't have to pay income tax on that money that was going in there. Okay. So that has gone away, which has now exposed us to over $100,000 tax liability. Like if we're not going to be putting it there and we show this income, we got to pay taxes on it. And as you guys know, I'm a firm believer that if you want to get yourself in a good position financially, you better have a tax strategy. Because if you don't, it's going to take you a lot longer. Some of you guys are paying 30, 40% in taxes. That's 30 or 40% of your year, 30 or 40% of your entire working life. Think about that. What's 40% of 40 years? That's how many years you're going to work just to pay taxes? Come on, not me. So I'm always looking, right? And real estate is definitely attractive for tax shelter. However, last year I learned that, and I want all of you to go vet this out. This is not financial advice. Something I heard and I did my own research on is that if you own a real estate investment piece of property and you rent it out short term, you can take any of the losses that you get on that property and carry that over to your personal taxes as a deduction on your income, against your income. And that was a game changer for me because usually with long-term rentals, again, go talk to your accountants, the properties and the money that is made from each of those properties stays with the property. In other words, if you make money on one property and lose money on another, you're not able to cross those corporations. Now, if they're all in the same corporation, yes. Okay. There's all these different what ifs. Okay. But let's just say you got one piece of property and you take a loss, one investment property, and you take a loss on that property and it's long-term rental. You cannot take that deduction over onto your personal income taxes. It has to stay with the property so that when the property does eventually make money, okay, then you can use those deductions. So if you lost $10,000 this year and you make $10,000 next year, you can carry that loss over to the next year, and it would nullify you paying any taxes on the 10,000. Okay. But if you're renting out short term, you can take out those deductions yearly. And that was a game changer for me. It was what actually got me really excited to pull the trigger this year because I needed a deduction this year. Okay. So that's why I started looking really heavily. There's other reasons why, and I'll tell you. I guess now's a good time. In Florida, you guys know we've had hurricanes, and there are a lot of people selling. There's houses staying on the market longer. Well, as an investor, that's a great thing for me. The longer houses are staying on the market, it tells me the less buyers there are out in the market, and the less buyers, then that swings the control of the deal to the buyers because there's less of us. If houses are selling like crazy, that swings the power to the sellers because there's less buyers and or more buyers, I'm saying. And that's what usually makes house prices go sky high. But it has swung the other way. So people are worried about hurricanes. They're worried about, and they should be with health, life insurance. Oh my gosh. It's not health. It's not life. It's property insurance. All the insurance is expensive. Property insurance, homeowners. It's crazy how expensive it is. That is driving a lot of investors out of the market. And so all of these things together has made it a buyer's market. So I've been shopping and putting offers out well below what people were asking. Well, I looked at a bunch of properties, and there was one thing here, one thing there why we didn't pull the trigger. And then I found a few months ago two houses actually sitting side by side, the same owner, right? And by the time I was able to get an offer in on one, the other one already had an offer, like instant, like within a day, there was already an offer. So that tells you, you know, these houses were distressed houses, but there are investors out there. Now, these properties were so distressed that a retail buyer that comes in with an FHA loan, there you can't touch them. Just too many repairs that have to be done. Nevertheless, um, the story goes there's an address of 809 and an address of 805. Okay. And we kept going back and forth with the realtors and, offers. And then this other one popped up. And so quickly, I started confusing the addresses and the two houses. And I'm going to be all over with my story here today. Um, but eventually, we got a deal put together for 805. I'm not going to tell you the street address, but 805. And as I'm talking to the realtor, I'm talking to her about some of the aspects of 809. And she says to me in this conversation, she goes, no, no, no. You've got the property. They had two sheds. It was a bigger shed and a smaller shed on these two different properties. And she says, no, you got the property with the smaller shed. And I'm like, no, no, I got the one with the bigger shed. And she goes, no, you got the property with the smaller shed. And she's like, you already had been in this house. Like I didn't even go in the other house. I was putting an offer on the other house just from the street, knowing what the values were. And so the short story is, guys, I actually bought a house that I thought I was getting the other house. And some of you might right now be going like, oh my gosh, like what a massive, massive like mistake, right? And here's the deal. The houses were very close in square footage. They were both 3-bedroom, 2-bath houses. The lots were identically the same size. There were just a few features different. The one house, the house that I didn't get, needed much more work. All right. It needed much more work. And that's why I didn't get it because I put in a lower offer. The house that I did get, it didn't need as much work, but it was obviously an investment house. So anyway, the funny thing is about this is there would be ways either way, like no matter what house I got, there was multiple ways for me to win on these properties. Okay. And that's what I wanted to share with you guys is don't be afraid. Don't be afraid to make the decision to buy a piece of real estate. If you've got multiple ways to win. Okay. So that's what I want to lay out for you guys today is the ways that I had in my mind to win with both of these properties, right? Number one, I've already shared with you is the tax strategy. So either one of these properties, if I got either one of them, I was going to be able to have the tax benefits that I've already laid out for you. Short-term rental, taking losses onto my personal taxes. So you can imagine I can go into this house, I can fix it up really, really nice for short-term rental and have a really high quality piece of property that I can use however I want to use this property for my business, family, or the short-term rental. Because it's well kept, I could sell it in the future. It's going to go up in value. So you think about from that perspective. If you got a really nice cared for piece of property, it's going to go up in value. So that's another way for this to carry over into increasing your net worth. All right. At the same time, the mortgage is being paid down by the people that are renting the house. Okay. So you've got three ways there: tax shelter, That's going to help you financially improve your financial position. You guys should always be looking for ways to pay less taxes. Number two, I've got a piece of property that's appreciating or going up in value because that's typically what happens with real estate. Sometimes it dips a little, but if you look at the last, like, can you guys right now buy a house at the prices you could buy a house 10 years ago? Probably not. And if you go back 20 years, no. I plan on being around for the 10 or 20 years. So this house will be worth more money in 10 years from now than it is now. Okay. You can't look at investments from what is it going to be worth next year. You got to look at investments of 10 years, 20 years out. Okay. This property will be worth more money in 10 to 20 years. And in 10 to 20 years, what I took out as a mortgage will be less than it is right now. 10 years from now, I will owe less on this house than I owe now. So I'll have less liability. Another thing that works in my favor. And I didn't have to go out and do the physical work to pay that mortgage. I put someone in the house, they go out and do the work, they earn money, they pay me rent, I pay the mortgage. That's leverage. That's the leverage piece that got me into network marketing, guys. The leverage piece of real estate where someone goes out, does the work, and gets the benefit, right? They go to work, they earn money, they get the benefit of living in my house, a nice house, okay, a shelter over their head. So that's worth something to them. They pay me for that. And then I take that, pay it against the mortgage. I'm not doing the work for the mortgage. They are, but I'm getting the benefit of my mortgage getting paid down, prices going up. So that's three ways, okay, that I'm earning money on this piece of property. The other thing is I bought a piece of property specifically with a big lot. And I know in the future, because of the prices of real estate in Florida, and some counties are already doing this house happens to sit inside a city's jurisdiction, not the county, that they're going to allow ADUs, additional dwelling units. The county already does. This city in the county does not. I don't know why. It's kind of strange to me. But I bought the property because I know in the future, we're going to have an answer for housing and affordability around housing because it is, you guys, you've seen the statistics that we've put out in the Freedom Factory in the Facebook group. And shout out, if you've not a part of the Facebook group, guys, get in that community. We communicate, we post stuff up there, get your mind thinking. It's a great place for all of us to hang out. Get inside the Freedom Factory community. I posted in the community a couple of weeks ago, and I'm kind of just trying to remember right now, the average age now of someone that can buy a home that in the United States is pushing up into the 40 and mid 40 range, where it used to be late 20s, early 30s. Now it's 40s and upper 40s before people are able to afford a home, which is absolutely crazy. The affordability is an issue, especially in Florida, but it's all over the US. Okay. So I bought this property knowing that with enough size of the lot, a big enough lot, I can put another dwelling on this property and rent that out as well. More cash flow, more appreciation on the property, more value on the property. Okay. So I'm laying out for you guys why, even though I ended up with the wrong, I'm going to say the wrong house, but it really was the right house. It's okay. Either house would have been the right house. But when I signed the deal, right before I signed the deal, about a week before is when I realized I thought I had the other house. And it's just nuts. But it's because of the things I just laid out for you. It's okay. So the whole point of this entire podcast today is in real estate, your money is made by having multiple ways of winning, multiple exit strategies, not just one. You should never buy a house with just the sole intention of flipping it, or never buy a house with just the sole intention of long-term landlording, because things happen. Like if you buy for long-term landlording and you're in a property in a neighborhood that has HOAs, what happens if the HOA gets outrageously high, something you got no control over? And that's your only exit strategy. You bought it at what it was worth, so you can't really flip it. Now you've got a piece of property that's negatively cash flowing. Just so have multiple ways to win when you put a deal together. So what does that look like? Well, some of the things I've already explained to you. Okay, don't buy the biggest house in the neighborhood. Okay, then what you should be looking for is some of the smaller, ugliest houses in nice neighborhoods. That's a good tip, right? Secondly, make sure you're not buying when it's a seller's market. You need to buy when it's a buyer's market, right? So when things were going sky high in 2020, the end of 2020 and 2021, I didn't buy because the prices for houses were absolutely insane. We wait a couple years, hurricanes come through, people get scared. So it's just like investing in the stock market. When there's fear, stocks come down. That's when you should be buying. When there's greed, people think they're, just buying because they're going to miss out. That's when you should be selling. So what should have happened, like if you've had houses in the 2000s and 2010s, when it spiked in 2020 and 2021, maybe that's when you should have sold. If that was one of your strategies to exit out because properties were sky high. They've come down now at least 30% in Florida, and they may come down even more. So be on the lookout for states and areas, guys, where it's a buyer's market, right? So in doing so, that gives you another exit strategy. So anyway, I hope from today's podcast, you're kind of maybe inspired to look at a new way of earning and investing in real estate. I think real estate's a great place because you have real assets, something that's yours, tangible. It's relatively a safe investment. Yes, it can go down, neighborhoods can change, but if you look at 10, 15, 20 years back to now, price, it's just more expensive, and it's done that for years and years. Yes, my interest rate was a little high. I'll tell you guys, I'm right around 7% in interest, which I don't like, but interest rates will come down, and when they do, I will refi and the payments will come down as well. So be on the lookout, guys, for when people are running one way, you run into those deals. Okay, and real estate's no different. Have multiple ways to sell. I've been told that you don't make your money in real estate when you sell, you make it when you buy, which is part of the negotiation price, right? I did get these guys down close to almost 20% off of their asking price. And the asking price was already a little bit below what some of the stuff was in the market. That's sort of nice. This house wasn't nice. Okay. But I got it down almost 20% below asking price. And I didn't have to do any crazy closing. It was financed, it was 30 days, no crazy promises, anything like that. I did allow them, part of the negotiations saved me about 10 grand, is I did allow them to stay in the house 2 weeks after the closing. And we held back $10,000 in escrow. So $10,000 of their money was held in escrow. That was my security that they were actually going to leave the house. It gave them 2 weeks to go find another place to go. And because of me allowing that to happen in the deal, they were comfortable with the price I gave them, which saved me about $10,000. Okay. So be looking for ways that you can negotiate on the front end because you make your money when you buy, not when you sell. Just remember that. So I hope this podcast has been good for you guys. I'm excited about the property. We're going to use it for a bunch of things. I'm excited about the neighborhood that it's in because the neighborhood's appreciating. And I'm excited for all of you to understand you can make mistakes. And if you've got multiple ways to win on a property, then more than likely you're going to win. And there should be no fear. Like that's what holds most people back from investing is, oh my gosh, it's a lot of money. The what ifs, the what ifs, the what ifs. But yeah, instead of thinking what if could go wrong, start thinking what if could go right. What if this happens? It could go right. Okay. So it's just a mind shift. It's a way of thinking the same way I think about business. I think about investments. Some people look at the negative. I look at the positive, have multiple ways to win. And if you will do that, then you're going to be able to play at a higher level in getting yourself to where you want to be in 5 years from now or 10 years from now. And that's why I love you guys being a part of what we're doing here in the Freedom Factory. So I may bring some people in to interview them along the way when we're doing this rehab, and maybe give you guys some insight from realtors. The mortgage, you guys already know the mortgage guy. Sam Wax was on one of my podcasts a long time ago. He put the deal together, the financial side. Maybe we'll pull some of the other people together, bring them in, and give you guys a little education along the way on this deal. We'll be posting pictures, and if you got questions, let me know, shoot them my way, and I'll answer those questions for you about this specific deal or other real estate specific deals. And remember, guys, that this is not financial advice. I'm not telling you to go do things exactly the way I'm doing it. I'm just telling you what I did so that maybe you can learn a little bit and maybe have a little bit of entertainment from it as well. So see you guys next week.